No, I think people are fooled if they think everybody's going back to the office in to the same extent that they were prior to 2019. The increased work from home trend has been a multi-decade trend. It's nothing new.
How will South Africa's property market perform in 2022? Well, joining me to discuss this is John Loos. He is a property economist with FNB. John, welcome back to the CRA channel. Last year, we had you on the show in about March discussing the impact of COVID on South Africa's property market. What trends have you observed over the last year or so in the property space in SA?
Well, we've seen activity levels, if one looks at all commercial property. It's still a mediocre market at best, but we've seen activity levels, according to our broker surveys, broadly rise since the end of the hard lockdowns in 2020. Probably not yet sufficient to turn around the overall rising vacancy rate trends, though. It's not a strong market yet, and demand is certainly not strong. If you split it up into the big three commercial property sectors, the strongest of the mediocre bunch is the industrial property sector, gearing up for bigger logistics, more logistics because of the online retail that's coming our way in a bigger way. Somewhere in the middle, retail, and on the weak side, the office property sector, which has the challenges of greater levels of work from home. But all have been recovering to greater or lesser magnitude. Industrial the top, and office the bottom, and hotel property, if you add the fourth one, a really weak one, also battling to recover, but definitely not there yet. The commercial sector is still on the weak side. The sector that's been very strong, or relatively strong, is the residential home buying market. That surged, there was a big surge in home buyer demand in response to the interest rate cuts of 2020, very aggressive interest rate cuts around about lockdown stage. And just after those hard lockdowns, big surge in home buying. That left a bit of a gap, though, in the rental market. A lot of aspirants, first-time buyers moving out of the rental market. So rental vacancy rates in the residential space had been increasing quite significantly up until about mid last year. What's becoming apparent now, and I think will become more the case because of interest rate hiking that started, is that the credit-dependent home buyer demand will now slow, or is probably slowing now, and the rental market in the residential property sector will actually start to pick up. We've seen the vacancy rate turning downwards in recent quarters. So a bit of a recovery in rentals starting, tapering off in home buying, a commercial property market that's broadly recovered but still mediocre. That's the situation as we sit now.
Enjoying this analysis? Click here to sign up for our 30-day free trial for more content from the CIA.
Anecdotally, it seems that many people are returning to the office. Do you think that the work from home trend was a temporary phenomenon associated with the pandemic, or do you think it's changed irrevocably the way in which companies operate?
No, I think people are fooled if they think everybody's going back to the office to the same extent that they were prior to 2019. The increased work from home trend has been a multi-decade trend. It's nothing new. The forced lockdown meant that there was a spike in working from home, and a lot of late adopters of this conferencing technology and so on just got forced into finally adopting it. It was all there beforehand. That was an abnormal situation. And yes, from hard lockdowns to normalization of economic activity thereafter, you would expect now that spike in work from home to taper off and a portion of the workforce to go back to the office. I think that's what will happen this year as vaccine rollout carries on. But to the extent they worked in the office prior to lockdowns in 2019, I seriously doubt it, because a lot of us have, as I said, we've been forced to try this work from home experiment. It's been highly successful. We will spend some time in the office, many of us, with colleagues face to face. There is a need for that interaction, but I think it's going to be a lot less. Whereas someone may have worked 5 days a week in the office or 4 days a week, it might be 2 days of the week now, and alleviating that wasteful commuting time and traffic congestion and all those ugly things associated with big cities to a certain degree by working more from home. I think that, and then from a sort of elevated level prior to compared to prior to COVID, the long-term trend towards increased remote work continues as these technologies get better.
So John, interest rates went up by 25 basis points in November. What are you seeing in terms of monetary policy and the effect on the property market? What other trends are you looking at for 2022?
Well, I think interest rates constrain the property market somewhat. I think it'll still be a better property year for the commercial property market at any rate this year compared to last year. But that pace of improvement, I think, gets slowed because of the gradual further rise that we expect in interest rates this year. 3 further 25 basis points worth of hikes. That's what we're penciling in. So commercial market sales activity and demand might be elevated this year compared to last year, but we don't think it'll be sufficient to turn around the multi-year rise in vacancy rates in all commercial property. That rising trend has been in place since about 2018, 2017. And our reasoning behind it is that if you look at what we expect GDP level to be, that real gross domestic product is that sort of measure of national production, and it's a key driver of overall demand for commercial space. And we only expect the level of national output to get back to what it was in 2019 this year. 2019's level was insufficient to stop a rising vacancy rate trend then. So I deduce that it'll probably be the same this year, and that the all property vacancy rate of MSCI, which was at 9.6% in the early parts of last year, will go into double digits this year. And rentals and property values will remain under pressure. But I don't think that we'll get that all out big nominal decline in capital values that we saw in 2020 with the big recession and last year. I think we'll go back to slightly positive nominal value growth on commercial property values. Not enough to keep up with general inflation in the economy. So in other words, the correction would then continue in real terms. I don't think we're out of correction territory yet, but in real terms, not in all-out nominal terms, which is obviously useful for mortgage lenders who, where the security, the property is the security. That's the expectation. So mediocre year, still rising vacancy rates, values, rentals, net operating income still under pressure, but improved from where we were last year. On the home buying front, home buying is very sensitive to interest rates, highly sensitive. It's highly credit dependent. And I think that just the start of interest rate hiking last year probably already dampened demand somewhat. So I think the home buyer market cools off somewhat. And then what happens next, that aspirant first-time buyer, many would say, let's postpone our purchase and stay in the rental market for longer until this is over. And so the rental market starts to recover somewhat. That we've been seeing already late last year, and I think that continues into this year. So improving residential rental market, slowing residential buying market.
So John, what about the tourism sector and hotels specifically? Are we going to be seeing an uptick in that area of the commercial property space?
I think an uptick, yes, in hotel property performance, but still lagging office and industrial and retail. Still the underperformer. It's got a lot of struggles on its hands. Firstly, it remains to be seen how fast the foreign tourists come back. That depends on vaccine rollouts, but let's assume that situation normalizes. Local tourists are still financially constrained because of the knock that financially the household sector of the country has taken. So for a lot, holidays and these nice luxuries will be on the back burner. So that recovers slowly. And then a portion of business travel I don't think is coming back, because I think we've Zoomified a lot of our corporate interaction. We don't just jump on a plane to go and have a meeting in Cape Town and stay overnight. I think that that often wasteful expenditure will be less, and a portion of business travel is probably not coming back. So quite significant challenges for the hotel sector, even though I would expect it to be better this year than last year.
John Loos, thank you very much for joining us on the CRA channel. Let's hand over to you, our viewers. What is your view of the property market in South Africa? Will you be buying property this year? Leave your thoughts in the comments section below. Also, a reminder that the CRA does more than only YouTube videos. We also have a corporate and individual subscription. You can gain access to our weekly risk alerts, our monthly reports, and our ongoing schedule of webinars. There's a link in the description below where you can find out more information. My name is David Ansara. This is the CRA. Until next time, take care.